How is everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today we are continuing the crypto series with installment number 26 in the series, and I'm going to bring you a very interesting report today. So this is from the Bank of International Settlements, the BIS. This is from their Annual Economic Report for 2025. We're not covering that whole report. We're just focusing on Section 3 of that report, which basically talks about the potential for a new monetary system, and it was all based around kind of tokenization and a shared ledger. And they have some interesting thoughts or comments on stablecoin and what stablecoin's role could or may not play in that new financial system. Now, before we get rolling, I just want to point out a couple things. There were a couple of reports. The Financial Stability Board, the FSB, they put out a report last year in December of last year called Recommendations for Cross-Border Payment Services. And one of the things that they talked about in there was stablecoins, and basically how stablecoins really aren't that great and have proven with Terra USD back in 2022 that they can blow up and they can go bad, and they can create a lot of volatility in the global financial system. And so there was that report, but then the Bank of International Settlements also put out a report in October of last year called Tokenization in the Context of Money and Other Assets. Now, that report, in a certain regard, kind of leads into this because it's both focused on this idea of tokenization and a basically what's called a shared ledger system, which we'll get into. So, but I covered both those reports in other episodes. I think I kind of covered them both in one of the crypto episodes, but I think I covered the Financial Stability Board maybe in a different episode. But you could go back. Like I said, I do have coverage of those. You could go back and check those out if you want to. But it was important for me just to note that up front here. So. Okay, now let's take a look at this report here. Now, this is just Section 3 of the overall report, and this is called the Next Generation Monetary and Financial System. There is a link to this report down in the description below if you want to go check it out. But and again, this is 38 pages. I'm not gonna bore you to death going through the reading through the whole thing. I just want to give you kind of the high points, the once over, if you will. So, what are some of the key takeaways from this report? Well, tokenization represents a transformative innovation to both improve the old and enable the new. It paves the way for new arrangements in cross-border payments, securities markets, and beyond. Tokenized platforms with central bank reserves, this is key, central bank reserves, commercial bank money, and government bonds at the center can lay the groundwork for the next generation monetary and financial system. Stablecoins offer some promise on tokenization, but fall short of requirements to be the mainstay of the monetary system when set against three key tests of singleness, elasticity, and integrity, which again is very interesting. I would point out that I covered in the crypto series installment last week this whole story of tokenization. I also did a separate episode. Should people be investing in stock, in tokenized stock? Robinhood put out these, basically these stock tokens, if you will, to basically buy shares in SpaceX and OpenAI. OpenAI came right out and basically said, yeah, we did not give them permission to do this. This does not equate to ownership or equity in OpenAI in any way, shape, or form. And now Robinhood released that to its European customers. And now it's getting some flack and getting some pushback because there's other companies involved and there are other players trying to get in on the same thing. So it really creates this quagmire, right? Like we see what's going on with Robinhood, we see what they're experimenting with, and then we get kind of the report of what this paper's saying that, tokenization is this great thing, it's this transformative innovation, it's going to change the way we do all this, that, and the other thing. Well, maybe not. But I think the more important takeaway from this paper is the discussion around stablecoins and how they basically say that stablecoins are not the end all be all of everything that we think they may be, and they may not play the role in this new monetary system that we think they will. So, but let's just run to the introduction here for just a second. So, the story of the monetary system and its role in the economy is one of continuous evolution throughout history. Technological progress in the monetary system has gone hand in hand with major leaps in economic activity. The innovation of money, recorded as book entries, managed by trusted intermediaries, gave rise to the new financial instruments that helped trade and commerce flourish. Paper ledgers gave way to digital ones, bringing profound change to the economy and society. The past several years have seen a wave of digital innovation that opens up unprecedented possibilities for money and finance. This chapter discusses how central banks can light the path to the next generation of the monetary and financial system. This is a system designed to expand the quality, scope, and accessibility of financial services by leveraging innovative technologies backed by sound regulation, while preserving the solid foundation of the existing system. Central bank reserves is a trusted final settlement asset, supporting private financial sector innovation. At the heart of this vision is the concept of tokenization, the process of recording claims on real or financial assets that exist on a traditional ledger onto a programmable platform. Tokenization represents the next logical progression in the evolution of the monetary and financial system, as it enables the integration of messaging, reconciliation, and asset transfer into a single, seamless operation. Its potential lies in its ability to knit together operations encompassing money and other assets that would reside on the same programmable platform. This could be made possible by a new type of financial market infrastructure, a unified ledger, which may or may not use distributed ledger technology, DLT. By bringing together tokenized central bank reserves, commercial bank money, and financial assets into the same venue, a unified ledger can harness tokenization's full benefits. So, there's a couple things I want to point out here. So number one, they're saying that obviously central banks remain at the heart of this. And I would remind people that the BIS has been pushing, and we'll see this in a minute when we get to the conclusion, the BIS has been pushing central bank digital currency for years now. And they've got all these projects. They've had 180 different central banks around the world working on all these different cryptocurrency and central bank digital currency projects all over the place. And obviously the Fed very much participating in that. Now, what kind of scares you a little bit about this is that they basically say that these new innovative technologies backed by sound regulation. Well, what do we have that's passing right now? Well, the Genius Act just passed right now. And then we have the Clarity Act, which is going to add the structural framework around digital assets here in the U.S. We already have the FedNow system, which effectively is built on a blockchain. Basically a blockchain rail system, if you will. So it kind of adds a little concern here that we seem to be setting up in the U.S. exactly what they are proposing in this paper. We're not quite there yet, but we're rapidly heading in this direction. I just say it because I don't trust the guys at the BIS. I don't like the people over in Switzerland. I felt for far too long that, we have kowtowed to the people over there in Brussels, we got to take, for some reason, the Fed and a lot of our regulators feel the need to take their marching orders for Brussels, which is just, don't understand. It's that whole, kind of banking cartel mentality. All the global elite of the bankers in the world, these central bankers, they love to get together and have their parties over there in Switzerland and Brussels and other places. And it's just that whole thing has just never sat right with me. And if you've read and studied some of the things that I have, I think you'd feel the same way too. But I digress. Let's not go down on this. Let's keep on point here. So, okay. So now we kind of go through this paper. And now they begin to break down like kind of stable coins, and they talk about this ideas of kind of singleness, elasticity, and then they talk about the integrity of money, and basically just saying how stablecoin really just doesn't measure up to that. And then we got to kind of go through here. They talk about money and trust, and then we roll down here. They talk about stable coins and the integrity imperative. Yeah, and then there's kind of some sidebar things. So like they have, limits to decentralized money, which is kind of interesting. And then they have a couple other interesting charts here. Stablecoins continue to grow, but volatility remains. And then it gets into, how do stablecoins measure up as money? Stablecoins fall short on the 3 key tests for money. This subsection discusses each in turn and closes with a discussion of additional concerns. So, and then it gets into stablecoin and the singleness of money, stablecoins and elasticity, stablecoin and the integrity of the monetary system. And then additional concerns around stablecoins here is there is an inherent tension between stablecoin issuers' ability to fully uphold their promise of stability and their pursuit of the profitable business model. When issuers invest in assets with some credit or liquidity risk, they cannot fully guarantee stability under all possible contingencies. Since holders can redeem their stablecoins at short notice, this reflects the status quo, where promises are generally, but importantly, not always honored, and the business model remains highly profitable as assets yield at least risk-free rates and liabilities pay zero. Alternatively, stringent liquidity risk management implies that reserve assets must be held in highly liquid risk-free assets. In the extreme, unremunerated central bank reserves. In such a scenario, stablecoins would operate a fully backed payment instrument with a business model largely based on payment fee income that is likely to deliver thin profits relative to the status quo. The prospect of broader use of stablecoins for payments and real economic transactions raises at least 3 additional concerns. First, jurisdictions may face challenges to their money sovereignty. Second, if stablecoins continue to grow, they are poised to have a large footprint in the markets in which they are invested, especially under stress conditions. And then again, a couple more charts here. Cross-border use of stablecoins has been rising, reflecting a mix of drivers. You can see USDC, Circle, and then Tether obviously remains the big player with Circle, not far behind. And then let's see here, and then it gets into artificial intelligence to combat money laundering, which is kind of interesting. The AI future of AML compliance, data detection, score, investigate, outcome. It's pretty interesting stuff. But then we get to our third reason. So third, with rising interconnectedness, there may be new channels for risks to spill over to the traditional financial system. If banks issue stablecoins, there are risks associated with a new class of liabilities that circulate on public blockchains without clarity as to whether and how they would benefit from deposit insurance. Particularly in times of stress, there may be rapid and unpredictable flows between different types of bank liabilities. More generally, if banks and other existing financial institutions become active in crypto markets, there is the risk of spillovers that undermine banks' ability to lend to households and businesses, trade in traditional markets, and perform their role in supporting the real economy. Now, this is very fascinating given everything that is happening right now with the Genius Act and this other regulation that's going in. And here they're basically warning that, hey, if banks start to get into this, there could be dire ramifications if there is some kind of run on the bank or some kind of stressful thing. You have a bank failure, and people start looking at other banks. Maybe they start pulling their stable coin. Basically what we saw happen in the crypto winter of 2022, leading into the run on the banks in 2023. Now there are people out there that will say, "Wait a minute, Joe." The failures of the banks of 23 didn't have anything to do with the crypto winter of 22. And I say no. I say my theory of the case is that the crypto winter of 2022 led directly to the failures of those banks in 2020, the spring of 2023. And if you go back and watch my first 4 episodes of the crypto series, I explain in vivid detail that whole scenario. So go check those out when you have a minute. Okay, so now as we go on here, it basically says, policy approaches to stablecoin, what can be done as far as like the regulation and different things. Basically, a lot of the things that we're seeing right now. addressing integrity and financial crime. Regulation should also mandate AML and CFT compliance, basically what all the bank, regulators and banking associations are asking for in the legislation right now. Stabilization mechanisms also need attention. That's, again, what the Clarity Act is all about. Regulators remain focused on the quality of assets backing stablecoin and the appropriate level of reserves. Requiring reserves of high-quality liquid assets can help to mitigate risks, while transparency measures such as regular audits and public disclosure requirements can support accountability. Okay, fair enough. And then we continue on, and then we get into the promise of tokenization. Tokenization stands to be the next logical step in the evolution of money and payments. Tokens are not merely digital entries in a database. Rather, they integrate the records of the underlying asset with the rules and logic governing the transfer of that asset. Tokenization enables the contingent performance of actions, meaning that specific operations are triggered when certain preconditions are met. So, and then we get down into, tokenization of the two-tier monetary system. And, kind of another interesting chart on domestic payment using tokenized commercial bank deposits. It's kind of like, here's what it is today versus here's what it would look like tomorrow. And then we go down and it gets into tokenization and the next generation correspondent banking. It just tries to explain how the transactions would work in between, different banks. And then it gets into the correspondent banking and the balance sheet updates, basically just, showing how the cross-border payments would happen here amongst all these different, amongst the different banks, and how the central bank and the correspondent bank and bank A and bank B, and how that would all flow through. And then this gets interesting. So this is a chart on AML, CFT compliance, and next generation correspondent bank. And they basically talk about this, and this is where it gets into the unified ledger. It talks about how, you've got a blacklist, you got a fraud engine, data source, and then money laundering engine, and how this all comes and works together on this unified ledger. And then we get another sidebar here, considerations for the technical architecture of a unified ledger, which again is kind of interesting. I'd probably get into that. And then it says, the choices of architecture for a unified ledger lie along a continuum. So you could have a single ledger, subnet ledger, a layered ledger, disparate ledger. So it's just, kind of interesting. I think a lot of it just depends on your levels of, sophistication. And then we get down into, beyond money, tokenization of government securities, obviously the bond markets and things like that. And then we have, government bond markets are growing focused of tokenization initiatives and, assessing the benefits of a tokenized financial system. And then, collateralized central bank lending in a tokenized environment just kind of explains again how they propose how this may all work. And now I get down to the conclusion. So I just wanted to read through this real quick. So trust in money remains crucial for the economy's functioning, regardless of technological change. Money is the coordination device for the economy, subject to important network effects. The singleness of money sustains this coordination. Elasticity and integrity are further crucial features that ensure money is fit for purpose. Technology offers many paths forward, but not all are equally promising. The issuance of private currencies like stablecoins satisfies a demand for new technological features. Yet, even with regulation, stablecoins' limitations cast serious doubts about their ability to be the mainstay of the monetary system. There are better ways to meet the legitimate demand for new functions in the monetary and financial system. Innovation built on unified ledgers is promising, unlocking efficiency gains and new contracting possibilities. The tokenization of central bank reserves, deposits, and government securities could represent stepping stones toward the next generation monetary and financial system. To make this future a reality, here we go. Central banks must play a catalytic role. In other words, they must be at the very heart of this. Where new forms of money are demanded for a tokenized system, central banks have to be the ones providing them. Of course, they have to be the ones providing them. More broadly, central banks can articulate their vision of future monetary system to provide a guidepost for all stakeholders. They can also help align regulatory frameworks and standards to ensure interoperability across jurisdictions and minimize hurdles in coordination. But of course they are. They are the answer. Of course, the central bank is always the answer to all our problems. By fostering trust and public-private collaboration, central banks can also ensure that unified ledgers are designed to meet the needs of diverse entities while upholding robust governance, resilience, and compliance standards. Central bank leadership is essential to unlocking the full potential of tokenized systems safely, efficiently, and inconclusively. The BIS is not just theorizing, but is working with central banks to develop these ideas. BIS Innovation Hub projects, including Agora, Mandela, Pine, and Promissa, demonstrate innovative technologies potential for the monetary and financial system. Central banks and private sector innovators are drawing on the lessons from this work to build the future financial system. Now, if you read between the lines there, what they're saying is that we need this unified ledger, and stablecoins are not good enough on their own, but tokenization is the promise here. But what we really need is a central bank digital currency, because obviously the unified ledger and tokenization, it doesn't really all work together the way it should, and stablecoins are not going to fulfill what we need. What we really need is that central bank digital currency, and we need the central banks to be at the very heart of this whole thing, to absolutely have tight and total control over everything that you or I say or do, and anytime, anywhere, anyhow. And again, this is kind of scary, because we are heading toward this right now with the very framework that we're building. And, and again, I am adamantly against a central bank digital currency. Do not want a central bank digital currency under any circumstances. And that's why the anti-CBDC bill that we have, that got passed by Congress and is now sitting in the Senate, is so critical. That bill has to pass. Okay. It has to pass, because we just cannot let that future come about. I'm not trying to downplay all this, or basically say it's horrible, we shouldn't do it, whatever. That's not what I'm saying. What I'm saying is, I don't want to live in a world where the central bank has the ability to just turn all our money off just like that whenever they decide, and that basically we have to live at the mercy of a central bank. That's all I'm saying. So okay, so again, I thought this report was really interesting. I thought people would find this fascinating. I came across this a few weeks ago, and I absolutely wanted to cover it, because you have to pay attention. The BIS does put out some good reports. They do a lot of research, and they do put out some really interesting things from time to time. They also put out some things that are a little scary, and they get very little. They have the BIS has in Brussels. They have tremendous influence. I mean, the BIS is known as the central banker's bank, and it's known for that for a reason, because the BIS is at the very heart of the global economic system in many regards. And so, the financial press here in America doesn't always cover these reports. They very rarely get talked about, but you better pay attention to them, because, everything that they put out has a way of becoming true. And I'm just saying, they carry a lot of weight. These opinions that get put out in these research reports by the BIS carry a lot of weight with a lot of the central bankers around the world, and in particularly our lovely people over at the Federal Reserve. So, with that being said, definitely stay tuned, because there will be more installments in the crypto series coming up. But I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on Rumble, YouTube, and all major podcast platforms. Please be sure to leave your comments down below, and I would love to hear your comments or your take on this particular subject, this particular report. And finally, please check out some of the other content on the channel. If you haven't seen any of the other episodes in the crypto series, go check that out. I've got a lot of great stuff in there, little something for everybody, I would say. But with that being said, thank you so much for listening. I appreciate everybody out there, and I hope everyone has a good day. I'll see you again real soon. Thanks a lot.